Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, I'll ask you a thumbs up and subscribe. Questions, comments, put those below. We've got a jam-packed episode this week. We've got an announcement from the Bank of Canada. We've got massive implications for the mortgage market. And we've got national housing update figures from the Canadian Real Estate Association for the month of June. So we're going to unpack all of that this week. This is going to be a fantastic video. But I want to frame this week's interview up with a clip from Tiff Macklem back in June of 2020. So roll the clip.
How much of an interest rate hike could the average Canadian household sustain before they would be unable to pay their mortgages or other credit market debt that they hold?
I want to stress that our focus is on supporting the recovery. The Bank of Canada has lowered interest rates to the effective lower bound of 25 basis points. We have embarked on a strategy of large-scale asset purchases, and that has a dual purpose, partly to restore, one purpose is to restore good functioning in our debt markets. The other purpose is to lower interest rates out the yield curve.
Sorry,
and we're very,
so go ahead.
for now and for the foreseeable future, we're focused on providing the monetary stimulus and delivering low interest rates to support the recovery. And that is lowering the debt service costs that households face, and companies and governments.
How many households would become insolvent with a 2 percentage point increase in interest rates?
Are extremely hypothetical. We have no intention of raising interest rates in the current circumstance.
Of course not. That's why I'm not asking about the current circumstance. I'm asking about the medium-term circumstance, sir. You've admitted that if inflation rises unexpectedly, that you would raise interest rates. Those were your words. You said that. And we need to, as Canadian parliamentarians, to know what that would do to households. How many would become insolvent if you had a 2% increase in interest rates?
The biggest risk to Canadians coming insolvent is not having a job.
Right.
The biggest risk to Canadians not being able to repay their mortgage is not having a job.
And so here we are today. We had an announcement from the Bank of Canada raising rates by 100 basis points, 1%, the single largest rate hike in one go since 1998. What's amazing to see is that the Bank of Canada, again, was forecasting 0 rate increases and forcibly said that back in the 2020 and into 2021, that there would be no rate hikes until the end of 2023. So they basically pledged they would keep rates at 0 until 2023. Now here we are with a massive 100 basis point rate hike. And in fact, you've actually gone from basically 0.25 to now we're at 2.5%. We've gone in the span of 4 months. You've gone from 0 to the Bank of Canada's target neutral rate in 4 months. So what does that mean? The bank has a target neutral rate, which is basically between 2.5% and 3.5%. And that neutral rate is basically where they view rates as not being stimulative to the economy and not being tightening to the economy. So that's their neutral rate. This is the fastest pace that a central bank has ever got to neutral. 4 months is all it took. And so nobody, I know everybody, there's people on here that said, rates are going to the moon. I don't think anyone projected that you'd get rates from 0 to the neutral rate in 4 months, and certainly not myself, so I'm happy to eat a humble pie on that one. But let's not kid ourselves about what this means for the Canadian economy, which I've touched on at length before. I want to get to some comments here, first of all, from the Bank of Canada following the rate hike announcement. So let's link in Carolyn Rogers' comments right here.
So I think it's important to step back a bit on housing and look separately at the effects of rising interest rates on individual home buyers and on the housing economy or the housing market itself and its effect on the broader economy. So at the individual level, We know that there's a segment of home buyers, particularly those that got into the housing market more recently, and they might have stretched to do so, and they may be sitting in a variable rate mortgage. And for those people, when interest rates go up, there's an immediate effect on their payment, and there's no doubt they're being squeezed. But that is a small segment of the population, not to minimize the effect on that segment of the population, but just to put it in the context of the overall economy. A reminder on some important numbers we've given you before. 65% of Canadians are homeowners, 35% have a mortgage. The vast portion of those are fixed rate mortgages, so their payments don't reset when interest rates move. About 10% of mortgages are variable, and of those, most have a fixed payment. So the effects of interest rates on most mortgage holders is not immediate. Of course, each year a portion of mortgages will renew, and so those payments will reset, and they will reset at a higher level with interest rates going up.
So first off, she's talking about variable rate mortgages and what does that mean moving forward. Obviously, we've seen a huge jump in variable rate mortgages. Now, there's kind of a couple important distinctions that I want to walk you through here, which very few people are paying attention to. I haven't heard anyone in the media talk about it, not one single person. And I would say the vast majority of homeowners, particularly people that are in this product, have no idea what they're about to get hit with. So there is a situation where, as Carolyn Rogers talks about, she says most of the variable rate mortgages that are out there, in fact, 80% of them have what's called a fixed payment variable rate mortgage. And so it's not actually a variable rate, a floating rate where where your payment increases with every rate hike. 80% of them actually have a fixed payment, which means every time the bank raises the rate, more of your mortgage payment will thus get shifted towards interest payment versus principal pay down. And so what happens is a scenario where you get to a point where rates go up so much that you're basically in a negative amortizing situation. And so the bank basically says, hey, listen, we've got to increase your payments. And that's called the trigger rate. And so typically speaking, is your trigger rate is 350 basis points higher than your initial agreed upon rate, typically speaking with most large Canadian banks. So I'll give you an example. I took out a variable rate mortgage, I believe back in November for 1.2%, pretty much at the lowest on the variable rate at that time. My trigger rate is 3.95%. We're now basically at 3.45% on that variable after that 100 basis point increase. So basically, another 50 basis point increase from the Bank of Canada will trigger that mortgage and will increase the payments. Now, I will be fine, but I think there's certainly a large cohort of people out there that aren't paying attention and will have no idea when they get a notice in the mail saying, hey, your fixed payment is suddenly going up. Now, again, it's not going to go up much. It's not going to go up a significant amount. You know, it might be $50, $100, $150. But it is going to go up, and this is going to surprise a lot of people. But let's continue on with Carolyn Rogers' comments right here.
At the broader economy level, housing is a segment of the economy we know is very interest rate sensitive. Most people who buy a house borrow money to do so, so housing activity is very sensitive to changes in interest rates. When housing activity and prices are high, it feeds through to the broader economy. People are more likely to renovate. They buy things that go along with housing. They buy appliances, they buy furniture. And we also know that housing has an effect on Canadians' confidence. So they're more likely to spend just in general when housing prices are up. Of course, the opposite happens when interest rates go up. Spending is more likely to be constrained on things like renovations and goods, and people generally tighten their belts a bit when housing prices are going down. Right now, and for the last year, we know that housing activity and housing prices have been unsustainably high. Basically, a spike in demand, low interest rates combined with chronically low supply, and we've had very elevated housing prices. This is part of what's feeding into excess demand in the Canadian economy, and as the governor said, our goal is to get that demand down, and part of restoring the balance of supply and demand in the Canadian economy is restoring that balance in the housing market, and that's what we're aiming to do. We do expect, as the governor said, that changes in housing activity and prices will feed through to overall economic activity.
Now, she's talking about the wealth effect and she's talking about consumer spending. Now, as I go back and remind you guys, we've talked about this many times on the videos, is that in Canada, over the past 5 years, 85% of real GDP growth, 85% of real GDP growth in Canada has come from housing, residential investment, and consumer spending. So basically what she's saying is, hey, don't worry, we're going to have this soft landing. Don't worry about housing. But she's just saying that, well, when housing activity slows, people stop buying new appliances and furniture and stop renovating. Well, there goes your consumer spending. So you're telling me you're about to cut the two cohorts of the economy that are responsible for 85% of real GDP growth in this country. So the long story short here is the Bank of Canada is sending us into recession. I think this is ultimately part of the plan. How do you get inflation down from essentially 8% without stoking a recession? I mean, you have to raise rates so much to get inflation down from 8% down to this, hypothetical 2% target rate. And ultimately, I think what's going to happen, I was listening to a fantastic interview from the chief investment officer of Bridgewater. Bridgewater is one of the largest financial institutions in the world, along with, it's co-founded by Ray Dalio. Is his view, and I certainly share the same view, is that central banks are going to hike rates to the point where you send the economy into a tailspin. You will have that recession. Soft landings are incredibly difficult to engineer. And you're going to have a situation where you're still going to be looking at inflation prints of 4.5%, 5% next year. And you're going to be in a situation where central banks are going to be like, what do we do now? And you're going to be almost basically looking at cutting rates with inflation at 5%. So I think we're in a situation now, because I'm going to get a lot of people that are asking me questions saying, well, why would they do this? Why are they intentionally don't they know they're going to send the economy into recession? Yes, I think that they do know that. I think right now is the political pressure of inflation is greater than the political pressure of a potential recession. So I think what's going to happen is we're going to hike into that recession. Eventually the pain is going to become so great. People are going to be, obviously losing jobs. And then there's going to be the political pressure on, hey, what the hell are we doing? Why are interest rates so high? We need to start cutting these interest rates. I think that's where it leads to, but that's sometime in 2023. So we'll kind of muddle on through this pain. But like I said, moving forward, the things that we kind of have to watch for now is the variable rate mortgages going up. The fixed payment variables are going to get triggered. A lot of them are going to get triggered, which again, nobody is talking about. The other thing to mention is that when the Bank of Canada raised rates by 100 basis points, you took variable rates from about 3.2% to now about 4.2%, which means that you now are getting stress tested at a minimum of 6.2%. Now remember this, is that over the past 12 months or so, over 55% of Canadians have been going with variable rate mortgages because at one point there was a 200 basis point spread between fixed rate and variable rate mortgages. So people were saying, well, why would I pay an extra 2% on my mortgage rate to lock in a fixed rate when the variable is 2% cheaper? And so you had all these people that were going into variable rate mortgages. Not only that, but when the fixed rate got up to 4.5, now it's at 5%. It means if you opted to go for that fixed rate, you had to get stress tested at 7%. And so people were saying, well, I can either get stress tested at 7%, or I can go for a variable rate and get stress tested at the minimum, which is 5.25%. Remember, the stress test is minimum 5.25%, or your contract rate plus 2%, whichever is greater. So people were going with variable rate mortgages at say 3.2 and only getting stress tested at 5.25%. So now the bank has raised that huge 100 basis points. You are going to push people into a higher stress test, which will instantly, overnight, reduce your borrowing capacity by about 10%. So instantly, you've just reduced borrowing capacity by 10%. There's really no escaping now. People were able to escape somewhat the higher fixed rates and going variable, and now that window has closed. And so I want to kind of now transition to, okay, well, what does this look like for the national housing market? We did talk last week on the Vancouver housing numbers. National home sales figures in Canada just dropped 24% year over year in June. Okay, so, and that was the third consecutive monthly decline in the National Home Price Index. Remember, the Home Price Index is a hedonically adjusted index. It works on a lag. It underreports the pace of the declines, but even that is showing a 3 consecutive month decline in prices. In fact, national home prices declined 1.9% month over month from May to June, that's a large move. Okay, national home price indexes should not be moving basically 2% a month. In fact, that was the largest seasonally adjusted decline in Canada's benchmark house price index on record. We have data that goes back to 2005, so that was the single largest monthly decline in that home price index. So just to kind of give you a context of where things are at. Now, I will personally bet on the situation where I think that where we're leading to, the Bank of Canada, again, I think is overly optimistic on the housing, but it's clear that they're willing to sacrifice the housing market as per Carolyn Rogers' speech. She doesn't seem to be too concerned, saying, well, only a portion of Canada has variable rate mortgages. But I think that, as we've talked about, in a highly levered, highly indebted society, there is going to be political pressures which reverberate and push back. The other thing that I'm watching for, and this is not a near-term discussion, but this is probably when the pain becomes pretty large and pretty intense. And like I said, once you start having these fixed payment mortgages triggering and moving up, I look at a scenario at some point, probably in 2023, assuming rates are still high and we're not cutting then, which is what markets are pricing in, by the way, not me. Markets are pricing in. So they're pricing in another 100 basis points of rate hikes this year, and they're pricing in rate cuts next year with the assumption that the economy will be in a recession. But I look on the policy measure side, I think that I put a decent probability that you look at an increase in amortization schedules. Don't forget that in 2007, we had 40-year amortizations. And don't forget that CMHC is still running 40-year amortizations on the commercial rental side. So these still exist. They just don't exist on the residential side. So I would not be surprised when the pain becomes large enough that policymakers look to offset the debt servicing, because we will hit record high debt servicing ratios in Q1 of 2023. So be nimble. It's going to take some time for things to play out, shape up. Again, people that are renewing their mortgages, people that are in these private fixed rate mortgages. This is a very interconnected system. I understand that the Bank of Canada and Carolyn Rogers is talking about, it's only a small cohort of society, so don't worry about it. Listen, this is a very highly interconnected economy, and it doesn't take a lot for that to have contagion and reverberations throughout the system. Remember, in 2017, not much of a downturn there. Decent downturn, but did we all forget that Home Capital Group was bailed out by Warren Buffett? I mean, it was a garden session correction in the Canadian housing market. So I think it's naive to think that we're just going to skirt through this and have a soft landing, assuming the Bank of Canada continues on the trajectory that it is determined to be on. So as always, hope that helped. See you next week.